All right, good early morning, peoples. We are ready to go with Pulte. All right. So, how did Palantir and how did Pulte do on Wednesday trading? All right, let's jump into a little summary here. We closed up slightly, 1.62%. And Palantir 130.18. We closed 1.61, so almost identical. We'd been underperforming a lot on the big news of S&P inclusion on Monday, and then still not as much, but closer on Tuesday, and now on Wednesday we're basically almost 1 for 1. So 71.79 we're up to on Pulte. Remember, this started at $50 back, what, 6, 7 months ago. I don't have the date in front of me. All right, let's take a look here. So, not a lot as far as the actual trades, small amount of trades. Coney had a lot more. Um, so, on Pulte, all they did was they have a current, I'll show you here, they have a current 115. So, they added 200 contracts. So, there were 75,000 shares bought. They went from 50 million 50 5,075,000 up to 5,100,000. Sorry, so 25,000. That's like their minimum that they show. People always go, "Oh, well, I bought 100 shares today and somebody said there was zero." They have these things called creation units. So they make a new creation unit when a total of 25,000 shares are traded. So you don't get anything reported. Like they're reporting 25, maybe it was 30, but they do it by creation units, right? So basically, very small on their synthetic. They bought 200 additional for 21.6 and they sold 200 for 621. So let me go show you that out here. So that net difference is down here, right? So it added, quote, I consider this like a loss. All it means is you're paying more for the call than what you sell the put for. Only when you're really out of the money. But remember, they're doing this on a 115 and the current price is 128, 129, 130 sometime during the day. So they're going to really pay more. Whereas this is a, 1.5, this is like 3.5 times, right? The further in the money. So this thing is 13.2% in the money and it expires the current 115 contract on July 18. All right, guys. So back to what you then care about. The other piece of this was simply adding 200 more. They like to do that. They like normally when they used to just have sold calls, naked calls, if you will. Now, typically, most of them are doing credit spreads. All that means is I sell a call like I used to, and then I buy insurance a much higher price, same expiration. So I sell short a 134. They're thinking there's 2 more trading days after that, 514 trading, and we don't think it's going to go above that. But in case it does, here's our insurance part of the spread. So you only have to pay 50 cents for the 200, but you get $1.29. So that's kind of how the spread concept works for you guys. And so those have been added in here and calculated and what they paid, and it determines our real profit. You don't care too much about up here. They moved things around. They added another US Treasury bill up here, and the rest is, this is First American government, just a way to house and store money, and then pure cash. So we're setting, as we moved up a little bit, this went up from 43 million to 45 million. Um, so that's sweet, right? That gives us another amount of profit money. The calls didn't change a lot. As you get up here to 130, this is the only one that's in the money. This is the one that's going to cost them for something they only paid about. They sold it for like 985. Well, when they have to buy it back, it's going to be like 2.6 million, right? So ideally, we don't care too much about this, but we want one of two outcomes with these spreads. We'd like it to go back to 126. Right now it's 130. So if it goes on Friday to 126, then we buy all of these back for pennies, having sold them for good dollar, $2, those kinds of things. Down here, we bought all this stuff. We're never going to get our money unless the insurance kicks in and this thing runs above 136, above 137. So basically, you would want these calls to run to 142, but then these guys would cost you a lot to buy them back, but all of a sudden these start becoming worth a lot of money. So you almost want it to run to like 150, 160. You pay a lot to buy these back. Your insurance is worth a lot, and then your synthetic just blows out, right? Because every dollar over 115 is big money. So that's how to think about what the nature of the calls are doing here. Um, they're not unencumbered because of the spread. Spread just gives you a little bit more insurance that, but like I said, you could come up here and close at 137 and only this call is going to make a little bit of money. This call is going to be break even. You're going to lose on all these, and all of these are going to cost you money. So that's really not ideal. You want it around 126, 127, or well over the top of these guys here. Um, so that's what I got. Let's go over again the numbers in terms of what we're looking at. And look at these. So what I do over here, this is the out of money amount, right? So the reason I knew the 126 is in the money because this is negative, right? We're already 3.32% in the money. This still has to go 1.38% from where it's currently at 130.10 or 18 to cause this to not be bought back for, remember, they have to buy these back for a couple of pennies, a nickel, depends, but basically nothing relative to what they paid for it. All right, so down here sums up things. So my description said, hey, are we on track for a $6 payout? The way I see it, yes. We have 550 in the bank that we collected here, and we have 580 worth of profit. This is the current 115 synthetic. So if we close the week even at 126, that drops a little bit, but so does the pain up here. We don't lose much money. Below 126, we make all of this sold money. And so maybe this drops to 550, but then we pick up, the 30 cents or something. So that's how that would work. Previous spreads cost us a good amount of money when we flew by the old calls and the insurance money, and we didn't quite go by the insurance money. So that cost us $1.65. So I've got us when we net all these out, and because this one is paper money right now, and these 516s will close out. So if this paper money is looking good, then, they may only pay mid fives. I mean, I don't see them paying four. I clearly see them, the way we're headed and the way we're behaving, I see them paying $5 again. There is a possibility we get $6. It's just not as concrete. Part of it is, since this is now a 720, right? Do they roll it? Do they cash it out? Well, I shouldn't say it's quite a bit over. It's only $15 over. So a lot's going to have to do with where we get to on Friday. on whether they do that. I would say if we blow through all these spreads here and it costs a lot of money to buy back, we're up around 135, 140, then I think they'll close these out. And then we'll have more cash. Yeah, we got to buy some back here, but our insurance will help some. So that's how I see it. It's going to really come down to Friday. Um, and then that sets us up for next week because remember, they're in Group B. Their declaration date is 5/21, so that's only 6 days away next Wednesday. And basically, the money has to get in the bank on Friday or Monday, or they don't consider it for payment. So everything's going to come down to the next couple of days. But heck, $5 payment, love it. $6 payment, I want to see it. All right, guys, Bruce with Targeted Wealth Creation. That's what I've got for you. This is not financial advice. I'm not a financial advisor. Always check with a financial advisor before you make financial investments. Thanks. Have a great day ahead. Bye for now.